Everything you have ever been taught about debt is a complete and utter lie. Since you were a little kid, sitting at the kitchen table watching your parents stress over bills, you were probably told that the ultimate dream is to work incredibly hard, save as much of your paycheck as humanly possible, pay off your mortgage as fast as you can, cut up all of your credit cards, and eventually live a beautiful, completely debt-free life. You have been systematically conditioned by society, by schools, and by traditional financial advisors to believe that debt is the ultimate enemy. You have been told that it is a financial disease that will slowly eat away at your peace of mind, steal your future, and keep you trapped in the rat race forever. And look, let us be completely honest with each other right now. If we are talking about maxing out a high-yield credit card at 25% interest to buy designer clothes you do not need, or financing a luxury car that depreciates the second you drive it off the lot, just to impress people you do not even like, then yes, that kind of debt is absolutely toxic. That is bad debt, and it will ruin your life. But what if I told you that while the middle class is desperately trying to claw their way out of debt, the ultra-wealthy are purposely drowning themselves in it? What if I told you that the richest families on the planet, the billionaires, the Wall Street elite, the legacy wealth dynasties that have controlled money for generations, use debt not as a burden, but as their number one most powerful tool to build massive fortunes, fund unimaginably luxurious lifestyles, and completely, 100% legally, avoid paying millions of dollars in taxes? Today, I am going completely behind the curtain to reveal a financial strategy so powerful, so incredibly lucrative, and so deeply embedded in the system that it almost feels like it should be illegal. But it is not. It is written right there in the absolute open in the tax code. It is a concept notoriously known in the high finance world as buy, borrow, die. And it is the exact framework the elite use to pass generational wealth down without handing over half of their life's work to the Internal Revenue Service. I am going to walk you through the exact math, step by agonizing step, of what I call the $500,000 tax secret that Wall Street deliberately hides from everyday investors. By the time we finish this conversation today, your entire perspective on money, taxes, and debt is going to be permanently shattered and completely rebuilt from the ground up. You are going to understand exactly how the game of wealth is truly played at the highest echelons of society, and far more importantly, how you can start using these exact same principles in your own life to protect your hard-earned money and accelerate your path to absolute financial freedom. To really understand how this massive wealth transfer works, we first need to take a step back and completely reprogram how we think about the tax code itself. Most regular folks look at the tax code as a punishment. They see it as a giant, terrifying rulebook designed to take their hard-earned money away every time they get a paycheck. You work 40 hours a week. You pour your blood, sweat, and tears into your job. And before you even see a single dollar of your own money, the government sweeps in and takes 20, 30, or even 40% of it right off the top. It feels like theft. It feels incredibly unfair. But wealthy people, investors, and business owners do not look at the tax code as a punishment at all. They look at the tax code as a treasure map. They understand that the government is essentially playing a massive game of behavioral economics. The tax code is not just a mechanism to collect revenue. It is a series of massive financial incentives designed to encourage people to do exactly what the government wants them to do. The government wants you to provide housing, so they offer massive tax breaks for real estate investors. The government wants you to create jobs and stimulate the economy, so they offer incredible tax loopholes for business owners. The government wants you to invest in companies and grow the capital markets, so they offer favorable tax rates for long-term investors. The reason the middle class gets taxed into absolute oblivion is simply that they are not doing the things the government incentivizes. They are just trading their time for a paycheck, which is the absolute highest taxed form of income in existence. Once you realize that the tax system rewards capital over labor, your entire financial worldview begins to shift. You stop trying to figure out how to work harder for more heavily taxed dollars, and you start trying to figure out how to acquire assets that the government will actually reward you for holding. And if you are having a massive light bulb moment right now and you are realizing that the entire system has been playing you, make sure you gently tap that like button and subscribe to the channel, because we go deep into these exact wealth building strategies every single week. And I do not want you to miss what we are dropping next. Now, let us dive deep into the actual architecture of this strategy. The buy, borrow, die strategy is divided into three very distinct, very deliberate phases. And the very first phase is simply to buy. But you are not buying just anything. You are not buying things that lose value over time. You are aggressively acquiring premium, cash flowing, or highly appreciating assets. We are talking about prime real estate, commercial properties, businesses, and most commonly, heavily diversified portfolios of high-quality stocks and index funds. The entire philosophy of the buy phase is rooted in the concept of never, ever selling your assets. Think of your assets like a golden goose. The middle class mentality is to buy a golden goose, wait until it gets fat, and then slaughter it and eat it. That is what you do when you buy a stock. Wait for it to go up, and then sell it to pay for a vacation or a new car. You killed the goose. The wealthy mentality is to buy the golden goose, feed it, protect it with your life, and live exclusively off the golden eggs it lays. Well, the goose just keeps getting bigger and producing more eggs. In the financial world, the golden goose is your principal investment, and the golden eggs are the compound interest, the dividends, and the capital appreciation. The absolute most critical concept you must understand in the buy phase is the difference between realized and unrealized gains. Let us say you buy a piece of real estate or a block of index funds for $100,000 over the next decade. Because of inflation, market growth, and compound interest, that asset grows in value to $500,000. You now have $400,000 in profit. But here is the secret that makes the whole system work. That $400,000 is considered an unrealized gain. It only exists on paper because you have not actually sold the asset. You have not realized the gain, which means the government cannot tax it. You could have a portfolio worth $50 million that started as $1 million, giving you $49 million in profit. And your tax bill on that growth is a beautiful, perfect zero. The wealth is there. The purchasing power is there. Your net worth is skyrocketing. But because you absolutely refuse to click the sell button, the IRS cannot touch a single penny of it. This brings us to the obvious question, the exact problem that the middle class always points out when they hear this. They say, well, that is great on paper. But what good is having all this wealth if you can never sell it and actually use the money? If all your money is trapped inside real estate or the stock market, how do you pay for your groceries? How do you buy your mansion? How do you fund your lavish trips to Monaco? How do you actually live? And that exact question brings us to the second, most crucial, and most misunderstood phase of the strategy, the borrow phase. This is where the true magic happens. This is the exact phase where Wall Street makes its money and where the wealthy separate themselves from the rest of society. When a wealthy person needs cash to buy a yacht, fund a business venture, or just live their everyday lavish lifestyle, they do not sell their assets. Selling assets triggers capital gains taxes, which could immediately wipe out 20 to 30% of their wealth. depending on the state they live in. Instead, they walk into a bank and they say, "Look, I have this massive portfolio of highly liquid, incredibly valuable assets sitting right here. I am not going to sell it, but I want you to give me a loan, and I will use my entire portfolio as collateral to guarantee that loan." The banks absolutely love this. From the bank's perspective, lending money against a massive, diversified portfolio of index funds or premium real estate is incredibly low risk. If the borrower defaults, the bank can just instantly seize the assets and liquidate them to get their money back. Because the risk to the bank is so incredibly low, they offer these ultra-wealthy clients unbelievably low interest rates. We are talking about rates that are often barely hovering above the rate of inflation, sometimes even lower. These financial instruments are typically called securities-backed lines of credit or margin loans, and they are the absolute lifeblood of the rich. Let us break down the exact mathematics of how this works, because this is where your mind is truly going to be blown. Imagine you have built up a stock portfolio worth $5 million. You have been disciplined. You have invested for decades, and your money has compounded beautifully. Now you want to retire, or you just want to take out $200,000 a year to live an incredible life. Option A is the traditional route. You sell $200,000 worth of your stock. The problem, you just triggered a taxable event. Depending on your tax bracket and state taxes, you might have to pay $40,000 to $60,000 in capital gains taxes just for the privilege of accessing your own money. Furthermore, that $200,000 is now permanently gone from your portfolio. It can never grow again. It will never compound again. You have permanently crippled your golden goose. Now let us look at option B, the borrow method. Instead of selling a single share, you open a securities-backed line of credit against your $5 million portfolio. You borrow the $200,000 from the bank. First of all, debt is not considered income by the IRS. Let me repeat that because it is the most important sentence you will hear today. Debt is not considered income. Therefore, borrowed money is 100% tax-free. You pay $0 in taxes on that $200,000. But it gets even better because you did not sell your assets. Your entire $5 million portfolio is still sitting in the market, actively growing and compounding. Let us say the stock market returns an average of 8% that year. Your $5 million portfolio just generated $400,000 in new wealth. Meanwhile, let us say the bank is charging you 5% interest on your $200,000 loan, which equates to $10,000 in interest for the year. Your portfolio grew by $400,000, and your interest cost was only $10,000. You literally made $390,000 in pure profit, completely tax-free, while simultaneously pulling out $200,000 in cash to live on. The asset growth is massively outpacing the cost of the debt. The debt is literally paying for itself, and your net worth continues to climb into the stratosphere, even while you are actively spending money. This is how the rich get richer, while seemingly spending money like it is going out of style. They are using the bank's money to live on, paying a tiny fraction in interest, avoiding massive tax hits, and letting their underlying assets compound to infinity. It is an infinite money glitch happening right in front of our eyes in the real world. If this exact concept is completely shifting the way you look at your own financial future, please do me a massive favor and smash that subscribe button. The algorithm absolutely loves it. It helps push this financial education to more people who desperately need to break out of the matrix. And it tells me that you want me to keep producing these incredibly deep, masterclass level deep dives. I appreciate you being here. So let us keep going and uncover the final, most mind-bending piece of the puzzle. We have covered the buy phase, where you accumulate appreciating assets and refuse to sell them. We have covered the borrow phase, where you use those assets as collateral to pull out tax-free cash to live an incredible life, while your portfolio continues to outpace the cost of your debt. But eventually, we all face the inevitable reality of life. We get old, and we pass away. And this brings us to the third and final phase of the strategy, the die phase. This is the exact phase that creates generational wealth dynasties and completely wipes out the massive tax liabilities that have been building up over an entire lifetime. To understand why the die phase is so incredibly powerful, I need to introduce you to the ultimate tax loophole, the holy grail of estate planning, known as the step-up in basis. This single provision in the tax code is responsible for saving the wealthy billions upon billions of dollars every single year. And it is the exact mechanism behind the $500,000 tax secret I promised to reveal to you. Let us run a very specific, highly realistic scenario to show you exactly how this $500,000 secret works. Let us imagine an investor named Robert. Decades ago, Robert was smart. He took $500,000 and he invested it into a highly diversified portfolio of index funds and real estate. Over his lifetime, Robert was incredibly disciplined. He never panicked during market crashes. He never sold his assets to buy shiny objects. He just let compound interest do its terrifyingly beautiful work. Over 30 or 40 years, that initial $500,000 investment grows to a staggering $3 million. Robert has $2.5 million in pure, unrealized capital gains. During his retirement years, Robert lived an amazing life. He traveled the world. He bought nice things. And he funded it all by borrowing against his portfolio using the exact strategy we just discussed. Let us say over the course of his retirement, he accumulated $1 million in debt against his portfolio. Now, if Robert were to sell his assets while he was alive to pay off that debt and cash out, he would be hit with a massive capital gains tax bill. 20% federal tax on $2.5 million of profit is exactly $500,000. That is $500,000 that Robert would have to write a check for to the federal government. But Robert knows the secret. Robert knows that he should absolutely never, under any circumstances, sell those assets. Instead, Robert simply holds the assets and the debt until the day he dies. When Robert passes away, his entire $3 million portfolio is transferred to his children. But here is the absolute magic of the step-up in basis. The IRS does not look at the original purchase price of $500,000 when the children inherit the assets. Instead, the tax code allows the cost basis of those assets to literally step up to the fair market value on the exact day that Robert died. For tax purposes, it is as if the children purchased those assets for $3 million on the day of his death. All of that to $0.5 million in profit that accumulated over Robert's entire lifetime. The IRS legally pretends it never happened. The tax liability is completely permanently erased. It vanishes into thin air. That $500,000 tax bill that Robert would have owed if he sold while he was alive is completely wiped out. Now his children inherit a $3 million portfolio and a $1 million loan. Because their new cost basis is $3 million, the children can immediately turn around and sell $1 million worth of the stock to completely pay off the bank loan. Because their basis stepped up, there is absolutely zero profit on that sale, which means there is absolutely zero tax owed. They pay off the debt. The bank is happy. The IRS gets absolutely nothing. And the children are left with a massive, completely tax-free $1 million inheritance that they can now use to start the entire buy, borrow, die cycle all over again for their own children. That is the true power of generational wealth. It is not just about making money. It is about completely shielding that money from the absolute destruction of taxation across multiple generations. Wall Street knows this. The legacy families know this. The politicians who write the tax laws definitely know this because they use these exact same loopholes themselves. But the everyday working person is told to put their money in a savings account earning 2%, pay off all their low interest debt, and grind until they are 65. It is an entirely different rulebook for the rich. Now, I know exactly what you are thinking right now. You are sitting there, mind completely blown. But a voice in your head is saying, "This sounds amazing, but I am not a multimillionaire. I do not have a $5 million stock portfolio. I cannot just walk into a private wealth management office and demand a massive line of credit. How does this actually apply to me? How does the everyday person, the middle class earner who is just trying to get ahead, actually utilize these elite strategies?" The beautiful truth is that the fundamental mechanics of buy, borrow, die scale down perfectly to the everyday investor. As long as you understand the vehicles available to you, you do not need to be a billionaire to start acting like one. The most common and accessible way the middle class can execute this strategy right now is through the very home they live in. Think about real estate. When you buy a house and pay down the mortgage while the property value appreciates over time, you are building immense equity. Your home might increase in value by hundreds of thousands of dollars over a decade. Most people think the only way to access that wealth is to sell the house, pay the massive realtor fees, pay the closing costs, uproot their entire family, and go buy a new house. But the financially literate understand that they can execute the borrow phase using a home equity line of credit or a cash-out refinance. You can literally go to the bank, borrow against the untaxed, unrealized appreciation of your home, pull out $50,000 or $100,000 completely tax-free, and use that money to go buy a cash-flowing rental property or invest in the stock market. You are using the bank's money, backed by your appreciating asset, to buy even more appreciating assets. You are becoming your own bank. If you are more heavily invested in the stock market rather than real estate, you can still execute this strategy on a smaller scale using margin loans available through almost any standard brokerage account. Today, in 2026, almost every major brokerage allows you to borrow against your invested capital. If you have $100,000 invested in an S&P 500 index fund, many brokerages will allow you to borrow a portion of that, say $20,000 or $30,000, at a relatively low margin rate. You can use that tax-free borrowed money to fund a necessary expense, bridge a gap in income, or even make another strategic investment, all without ever having to sell your core index funds and trigger a taxable event. The infrastructure is there for you to use. The tools are available to everyone. The only thing separating the ultra-wealthy from the middle class is the financial education required to actually pull the trigger and use the tools effectively. Wall Street hides this secret not by locking the door, but simply by never telling you the door even exists in the first place. They want you buying and selling constantly. Why? Because every time you buy or sell a stock, the broker makes a fee. Every time you trigger a capital gain, the system churns. The financial industry makes its money on transactions, on movement, on chaos. The buy, borrow, die strategy represents the exact opposite of what Wall Street wants you to do. It requires immense patience, absolute stillness, and a complete refusal to transact unless absolutely necessary. When you hold assets forever and borrow against them, you are starving the transaction machine. You are keeping the power and the wealth entirely in your own hands. Of course, we're having an incredibly honest conversation here. And I would be doing you a massive disservice if I did not talk about the risks involved. Because debt is essentially financial leverage. And leverage is a double-edged sword. It can multiply your wealth at terrifying speeds. But if you are careless, it can also wipe you out completely. The single greatest risk in the buy, borrow, die strategy is the dreaded margin call. Let us say you borrow heavily against your stock portfolio. Your portfolio is worth $1 million, and you borrow $500,000 against it. You are leveraged at 50%. Suddenly, a massive global recession hits. Panic sweeps the markets, and the stock market crashes by 40%. Your $1 million portfolio is suddenly only worth $600,000. The bank looks at this situation and completely panics. Their collateral is evaporating. They will issue a margin call, demanding that you immediately deposit cash into your account to cover the loan, or they will forcefully sell your assets at the absolute bottom of the market to get their money back. You would be permanently destroyed. This is exactly how over-leveraged investors lose absolutely everything during market downturns. But the ultra-wealthy know this. They understand market cycles, and they respect the danger of leverage. That is why the golden rule of the borrow phase is extreme moderation. The truly wealthy never borrow anywhere near the maximum limit. If they have a $10 million portfolio, they might only borrow $1 or $2 million against it. They maintain a loan-to-value ratio of maybe 10 or 20%. At that low level of leverage, the stock market would have to essentially drop to zero for them to ever face a margin call. They have built an impenetrable fortress of safety around their wealth. They are taking calculated risks. Not gambling, they use just enough debt to fund their lifestyle and avoid taxes, but never enough to actually put their underlying golden goose at risk of being slaughtered by the bank. This entire philosophy requires a massive paradigm shift. It requires you to stop looking at debt through a moral lens of good and evil, and start looking at it purely as a mathematical tool. Debt is just a hammer. You can use a hammer to build a beautiful mansion for your family, or you can use it to smash your own windows. The tool itself is entirely neutral. The outcome is dictated entirely by the skill, the discipline, and the education of the person holding it. When you understand that fiat currency is designed to lose value over time through inflation, you realize that holding cash is mathematically guaranteed to make you poorer. The money sitting in your bank account right now is slowly rotting away, losing its purchasing power every single day. The wealthy know that inflation destroys the value of cash, but it massively inflates the nominal value of hard assets. When you buy real estate and hold great companies, inflation pushes the price of those assets up. And when you borrow against those assets, you are borrowing dollars today that have a certain value, and you are paying that debt back years later with dollars that have been heavily devalued by inflation. The debt literally shrinks in real economic terms while your assets explode in value. It is the most beautiful, perfectly engineered wealth-building machine ever created. And the absolute best part is that it requires almost zero daily effort once it is set up. You are not day trading. You are not flipping houses. You are simply acquiring the best assets in the world, locking them away in a vault, strategically tapping the equity when you need capital, and letting the massive, unstoppable forces of compounding and inflation do 99% of the heavy lifting for you. As we wrap up this deep dive, I want you to take a hard look at your own financial trajectory. Are you playing the game by the rules designed to keep you trapped as a high-tax employee? Or are you starting to learn the rules of the architects? The transition does not happen overnight. You do not wake up tomorrow and instantly execute a flawless buy, borrow, die strategy. It starts with the absolute fundamentals. It starts with killing off your toxic consumer debt so you have the cash flow to actually start acquiring the golden geese. It starts with aggressively buying into broad market index funds or putting down payments on real estate instead of buying liabilities that drop in value the moment you touch them. It starts with building a foundational pile of capital that is large enough to eventually borrow against safely. You have to build the mountain before you can ski down it. But the very first, most critical step is exactly what you did today: acquiring the knowledge. You cannot play a game if you do not know the rules. And for far too long, the middle class has been kept completely in the dark, playing checkers while the elite are playing three-dimensional chess. You now hold the exact blueprint, the $500,000 tax secret that has built dynasties. The veil has been lifted. You know how the machine actually works. The only question left is what you are going to do with this profound information. Are you going to go back to sleep? Go back to paying maximum taxes? And go back to fearing debt? Or are you going to start aggressively acquiring assets, legally minimizing your tax burden, and building a fortress of wealth that will literally outlast your own life? The choice is entirely yours. I want to thank you for spending this time with me today and opening your mind to these incredible concepts. If you found immense value in this deep dive, please do not forget to hit that subscribe button. Leave a comment below letting me know your biggest takeaway, and share this with someone who desperately needs to hear the truth about how money actually works. Keep building, keep acquiring assets, and I will see you in the next one.